Assalamu alaikum wa rahmatullahi wa barakatuh. Distinguished guests, speakers, and participants, ladies and gentlemen, a very good morning, afternoon, and evening to all of you. On behalf of the General Council for Islamic Banks and Financial Institutions, I have the honor and pleasure of welcoming all of you today to this webinar on central bank digital currencies, how it enables cashless societies and financial system stability. Ladies and gentlemen, the rise of central bank digital currency has been a prominent topic in the world of finance and economics in recent years. With the advent of blockchain technology and the rise of cryptocurrencies, many central banks have been exploring the possibility of issuing their own digital currencies. CBDCs possess many potential benefits, including increased efficiency and security in payment and settlements, greater financial inclusion and enhanced monetary policy transmission. However, there are also a number of challenges that need to be addressed before CBDCs can be successfully implemented. These include ensuring the security and stability of digital currencies, warranting compatibility with existing financial infrastructure, and addressing concerns about privacy and data protection. CIBAFI is organizing this webinar to shed light on CBDC's recent global developments and the impact of this new technological trend on the financial sector. The webinar, through the participation of key industry experts, will look at the benefits and the challenges associated with the implementation of CBDCs, in addition to their different potential use cases and future prospects. Ladies and gentlemen, before we start, we would like to make a couple of announcements. If you have any questions throughout the webinar, please do not hesitate to write them in the Q&A section that appears below, and we will try our best to answer these questions as much as we can. The webinar will be recorded and posted on CIBAFI's social media platforms in the coming days, so please follow us on social media. We will also appreciate your kind feedback on the organization of the webinar by filling out the evaluation form that will be sent to your email after the end of the webinar. Now, without further ado, I have the pleasure to call upon Dr. Abdelilah Belatik, Secretary General of CIBAFI, to deliver his welcoming remarks. Dr. Belatik, the cloud is yours.
Thank you, Rachid. Bismillah ar-Rahman ar-Rahim, wa salatu wa salam ala Mawlana Rasulillah wa ala alihi wa sahbihi ajma'in. Excellencies, distinguished guests, Assalamu alaikum wa rahmatullahi wa barakatuh, and good morning, good afternoon, good evening to all of you, wherever you are. On behalf of CIBAFI, I'm pleased to welcome you to this webinar to shed light on the central bank digital currencies, recent developments and trends, and the impact of these technological trends on the financial sector. Before we begin, I would like to thank our distinguished speakers for taking the time to share their knowledge and experiences with us. I know some of them are in different time zones and so on. So thank you very much for making the time for this, despite being very early in some of your locations or perhaps late for others. The financial sector has always been subjected to change and evolution. It is an industry that has been around for a long time, and it has been known for its research, conservatism, and resistance to change. However, things are changing, and they are changing fast. The financial sector is being challenged by new financial technologies on all fronts. In the past few years, we have experienced a revolution of financial services. The technological development promoted significant change to many aspects of the financial sector, payments and access to financing. Financial services are becoming more and more convenient, and everyone allowing them to opening new ideas and to new technologies such as artificial intelligence, big data analytics, machine learning, distributed ledger technologies such as blockchain, stablecoin, crypto assets, and others. One of the technological trends that has the potential to bring significant disruptions to the financial sector is digital currency and cryptocurrencies. The idea of a digital currency dates back more than 25 years before. Early digital currency examples include DigiCash from 1989 and eGold. Both of these were created by central agencies. On the other hand, after the financial crisis with the Bitcoin emergence in 2009, this changed the way we think about transactions and record keeping through a decentralized ledger and creating assets that could be traded outside of any sovereign monetary authority. Now, there are thousands of crypto assets that operate in similar way, collectively generating billions of dollars in transaction volume every day. However, a turning point was when big tech started showing their interest in issuing their own cryptocurrencies with all the potential risks that this may bring to financial stability, data privacy and protection, and security, and AML issues. The attitude of different countries towards these crypto assets varies. Some believe these assets are the currency of the future and take active measures to support their development. Others are more skeptical, but they take them for granted. In recent to these developments, central banks have been investigating the idea of issuing their own digital currencies for a few years now. The motivation of these efforts has been twofold. First, to address concerns that privately issued cryptocurrencies could undermine financial stability and traditional monetary policy. And second, to improve access to central bank money for private citizens, thereby increasing financial inclusion and reducing payment friction. The transition to a digital currency has the potential to bring many positive changes to a country's economy, but it may also bring challenges and unintended consequences. Interest in CBDCs has increased in recent years. We know from various research and surveys that over 90% of central banks now globally are either researching the potential of CBDCs or they are experiencing or having some pilot projects either locally or cross-border. So we will certainly be seeing more and more of these, and this in the region, in Europe or China, having some practical trials and pilots for this. Countries also like Bahrain, the UAE, Saudi Arabia, Malaysia, where Islamic finance is considered a systemic industry, are involved in some of these projects, either through research or some active pilot projects. As for CIBAFI, as the official umbrella of Islamic financial institutions, it is a topic that is very important to us, and as our mission is to continue promoting the Islamic financial services industry and addressing the challenges and the new trends. We have established an innovation and technology working group, and among the topics that is under discussion within this group is central bank digital currencies and other projects that will come through, looking in particular and some of these innovations and technology trends that will have and are having either now or will have in the future significant impact on the financial sector in general and or on the Islamic financial services industry. So stay tuned of what we are going through and the production that we will be having in the next few weeks and next few months on related on subjects and topic related to innovations and technology, be it on CBDCs or other topics such as the blockchain, practical implementation and implications for the financial sector and for Islamic banks. Before I conclude, I would like again to thank our distinguished speakers and participants for the valuable sharing of their experiences. I hope the discussions will be, I'm sure, will be very interesting to shed light on some of these new trends and how they are now impacting us or will be impacting us in the future to be a resilient industry in the global financial system. Thank you.
Thank you, Dr. Abdelilah Belatik, for your welcoming remarks. Ladies and gentlemen, we would also like to welcome Dr. Tausan, Deputy Chief of Payments, Currencies and Infrastructure Division, Monetary and Capital Market Departments at the International Monetary Fund, to deliver his opening remarks and set the scene for the next session. Dr. Tau, please, the cloud is yours.
Thank you. Good morning, afternoon, evening, everyone. I'm Tausun. Now I'm in Washington. I'm very honored to be joining you to give a quick overview of our current working on CBDC. I read your topic. It's about CBDC to promote digital cashless payment and promoting financial stability. It's a very interesting and challenging topic. To be frank, promoting digital payments, promoting cashless society does not necessarily need a CBDC. We have many other type of potential digital form of money, like e-money. You can see in many countries, e-money is developing quickly, reducing the use of cash. So this is CBDC is only part of a solution. So let me quickly give you an overview of my understanding of the topic in 3 parts. One is about a big picture of how do we see CBDC in the context of the digital money world. The second part would be I want to give you a quick example. What are the current global central banks thinking about CBDC? What are the major questions they are asking IMF to provide assistance? The third part would be what are the major challenges? I will give you 2 examples of the challenges for you to think about. It's an ongoing process. So that's my 3 parts. Coming back to the first one, regarding the digital money, in IMF, we have a kind of tax money, like something like this. If you discuss the tax digital money, there are 4 possible solutions, possible category. One is e-money, as I mentioned just now. It's a kind of ongoing payment instrument in many countries for the last 2 decades. This is one. Second one is about stablecoin. As we see, we are seeing both domestic and global stablecoin, which can provide some kind of function of payments. Right? Of course, stablecoin can also provide some kind of function of investment support. The third one is about the crypto assets. Many countries are thinking about crypto assets. Some part of the crypto asset function is related to payments, especially a multilateral platform. The fourth one is CBDC, which is more central bank driven digital money payment instruments. CBDC is more than a payment instrument, but also a settlement assets. So that's a kind of big picture of when we discuss digital money. So from this kind of tax money, we can see CBDC is only one possible solution of digital payment or digital money. So when we engage with the member countries, we discuss CBDC, but we do not endorse any country to issue a CBDC without considering the broader possible other solution like e-money, even stablecoin, right? So I think that's a kind of big picture. The second part, I want to quickly summarize the major concerns by member countries. How do they see the major issues they are thinking about on CBDC? Now, we in the IMF, we have received more than 40 country requests on CBDC. Basically, they ask us, how do we think about CBDC? They have laid out many detailed questions, but to summarize, they ask four major questions. One is about exploration. They are asking, what is CBDC? What's the difference between CBDC and e-money, between CBDC and crypto assets, between CBDC and stablecoin? What's the specific use cases of CBDC? What are the pros and cons of CBDC? Right, so that's a kind of exploring stage. Many central banks, especially emerging market and low-income countries, they are thinking about it this way. So this is number one. The second one is many central banks are trying to see how do they design CBDC? How do they design for the objective they set up in their central bank? For example, some central bank, they pay more attention to promote financial inclusion. Some central banks want to control the monetary sovereignty. Some central banks want to see how do they promote computation within the domestic payment instruments. So they ask, how do we set the limits of CBDC wallets? How do they set the interest rate for CBDC? How do they set a kind of technology? Is it centralized or decentralized? And how do they control the whole process to ensure financial integrity and protect privacy while using the data? So this is kind of design question by many central banks. The third one, some central banks are progressing very quickly. They are asking, how do they do proof of concepts? How do they do pilot? They are asking what kind of stakeholder they should get involved. How do they communicate with the public? How do they manage the possible assumption and test them? How do they assure understand the major dimensions of CBDC before real production of CBDC? So that's the third part, proof of concepts and the pilot. The last one is very challenging. It's about the policy implication. They are asking what's the implication of CBDC for monetary policy transmission, for monetary policy operation, for financial stability, for market computation, and for regulation, even for legal system, right? So they are asking this kind of policy implication. From the cross-border perspective, some countries are asking, how do CBDC can manage the capital flow? How can they take advantage of CFM, capital flow management, to promote CBDC and cross-border payments? So that's a kind of big picture of what our central banks are thinking about. Four categories: exploration, design, proof concepts or pilots, and policy implication. So that's the second part I want to highlight. The last one is about challenges. We know CBDC can provide many potential benefits, right? Potential cheaper, efficient, and low cost services. But now we see many countries are trying to think in a broad picture, what are the possible challenges and how to address them. I'll give you two examples of the major challenges. It's not only from one country, for many countries. The number one is a trade-off. It's a challenge related to trade-off. Let me give you two specific examples. One is a trade-off between adoption and financial stability. Now, many central banks are thinking whether it's issued the CBDC or not. They are thinking, try to set limits for CBDC wallets or CBDC balance. Right? One of the major reasons they are thinking about that is try to manage the potential banking disintermediation risk, trying to manage the process to ensure the monetary policy transmission without a major breakup. Right? So that's one part of objective. On the other hand, if you set up the limits for the CBDC wallets, that means the potential usefulness for the users could be hampered. Basically, if I want to pay a certain kind of money beyond the limits, then I cannot do that. So that will damage my incentive to use CBDC. That will damage my adoption rates. Right? So you can see this is one example. We want to ensure financial stability, ensure monetary policy transmission, ensure banking intermediation, but we are trying at the same time, we are running a risk of low adoption, which is exactly the same case now. Several central banks, they have launched CBDC, they see a very low adoption rates. Right? Adoption is very important. If you cannot adopt the CBDC, you cannot adopt you cannot realize your policy objective. Right? So that's one example. Another example, many central banks are trying to promote financial inclusion. The financial inclusion means, especially for low-income countries, you have to provide services for those potential users who are unbanked. They have no bank account, right? But they have access to mobile phone. So if you want to promote financial inclusion, that means you may not do sufficient KYC. If you have a wider coverage of unbanked people, you do not do KYC, that means you have provided a larger coverage of financial inclusiveness. This does not collect basic information from users. That means you have a better protection of privacy. So the more financial inclusion, the more coverage and a low threshold of KYC, the better privacy protection. But on the other hand, if you have a low KYC, that means the country may face financial integrity risk, like AML CFT risk, right? So this is also kind of trade-off between the threshold, how high the bar you set for the KYC, how high the bar you set for AML CFT. Right? So this is a second example of the trade-off. So to summarize my quick overview, I think the key challenge now for central bank, they have to think about what's the major possible advantages of CBDC in your country, tailored to your country. You may not think about CBDC. You may think about something else. If something else do not work, you can think about CBDC. Even thinking about CBDC, we have to think about the possible trade-off. What's the most fundamental challenge the country are facing? What are the most possible balance of the policy package you may think about? So this is quite important. The last major point I want to highlight, in the current globalization process, we are also facing the risk of increasing fragmentation. When we discuss with many central banks, some central banks, especially a relatively large central bank, they are trying to do something like a regional framework to use their CBDC in a region, right? So if globally we have 190 member countries, but we are seeing some blocks of CBDC in different regions. That's a kind of challenge for some countries, especially possible currency substitution. So we have to think about, from an IMF side, we have to think a way how to promote the integration of the possible multilateral platform to avoid fragmentation, especially with the increasing geopolitical risk in different regions. So we have to manage the process to ensure a kind of smooth cross-border payments using CBDC stablecoin. I think that's a kind of big picture we have to think about. Let me conclude. I think CBDC is an ongoing process. It's not a one shot. It needs several years, or 10 years, or even decades to explore. The fundamental question we have to ask us, how do we address our fundamental pain points in my country? How do we ensure adoption while ensuring financial stability, ensuring monetary policy transformation? I think that's my quick summary of my thoughts for the discussion. Thank you.
Thank you, Dr. Tao, for your opening, and also that highlights actually a number of points and questions that will be the subject of discussion in the panel discussion of this webinar, which I have the pleasure to moderate. We're joined today with a number of inspirational speakers to discuss the key challenges in adopting CBDCs and what standards, regulation, and strategies are followed for successful adoption and implementation. So ladies and gentlemen, please allow me to present the speakers of this panel, starting with Ms. Aslina Idris. She's the Director Corporate Services at Payment Network Malaysia. And we have also Dr. Haziq Mohammed, Managing Director and Principal Consultant, Stellar Consulting Group, Singapore. We have also Mr. Mustafa Sayed, Senior Manager, Digital Solutions, PwC Middle East. We have also Ms. Manal Rifki, Digital Asset Associate at Pearl Hill Advisors in Singapore, and Ms. Ainur Kinzayeva, Head of the Digital Tenji Project Payment and Financial Technologies Development Center at the National Bank of Kazakhstan. Welcome to all of you. So we will start our panel. As you know, there has been a lot of debates over digital money. These debates are being fueled by the rapid emergence of Bitcoin and other decentralized cryptocurrencies, as well as stable coins, with more countries exploring the potential of programmable money, and a number of central banks are turning their attention to CBDCs. CBDCs are not cryptocurrencies, but they share some similarities. Both are peer-to-peer currencies, but CBDCs are issued by central banks, and cryptocurrencies such as Bitcoin are created independently. Central banks all over the world are exploring new technologies for cross-border payments. So what are CBDCs and how will they affect the future of money? What motivates this emergence, and what are the developments globally in terms of implementations? These are some of the questions that our guest speakers will address. And first, we will start with the basics, looking at an overview of CBDCs, definition, growth drivers, and historical perspective. And for that, I will call upon Ms. Aslina Idris. If you can please give us few details on the definition and the growth drivers of CBDCs in general in 15 minutes, please.
Okay, thank you very much. Assalamualaikum warahmatullahi wabarakatuh. Good day, and thank you for inviting me. The expression CBDC actually began, I think, gaining momentum and traction around about 2016, 2017. And at the point in time, you have situations where, stable coins were gaining momentum, and central banks, especially the ones in ECB, Bank of England, they started to look at, what developments and what should they do in response to the growth of stable coins. Initially, they viewed it a bit negatively, in the sense that because of the speculation and the hype around it, But then after going deeper into it, it started to gain momentum, and research started to be done into it. Now, if we want to look at CBDCs alone, to qualify as CBDC, it has to be issued by a central bank, or the value must be guaranteed by central bank. It must be legal tender, right? So you cannot have a private institution issuing money that is backed by some reserve currency or some legal tender and call it CBDC. Those are called stable coins, right? So there's actually an extensive study being done at ECB around programmable money, and the main difference between stable coin, which is from a default risk, from a counterparty risk, from a regulatory risk, the risk is higher, as opposed to CBDC on the other end of the spectrum, where there's lower default risk, lower counterparty risk, and lower regulatory risk, simply because it's backed by the central bank of that particular country. Now, from a CBDC architecture perspective, you can actually dissect it many ways, as many as six ways. There is, on one hand, whether it is retail, that means available for the general public and businesses, or wholesale, that means it's available only for banks and central banks, right? So that's one way of looking at it, or both. The second element could be the purpose, right? CBDCs can be done for domestic payments. It can also be done for cross-border payments to facilitate the efficiency of that, or it can be done for both, right? The third area is actually architecture. And from an architecture point of view, this is where it gets very interesting. You can either have the central bank issuing it directly, or issuing it indirectly, meaning through intermediaries, and then it goes into somebody's e-wallet. And it can also be a hybrid, where you actually have the central bank issuing it directly, and the central bank issuing it via a third party, but it's claimable against the central bank directly, right? The other bit about CBDC as well, which is kind of like a widely held misconception, is that not all CBDCs are DLT based. They are not based on blockchain or digital distributed ledger technology necessarily. It could either be on existing infrastructure, but it's kind of like digitalized. It could be DLT, and it could be a combination of both. Now, the fifth element of CBDC is also access. Now, certain countries actually design their CBDCs in a manner that is account-based. So meaning it is identity, just like how you have your savings account in your bank account deposits, right? The other element is also, it could be anonymized or token-based, right? So that's another permutation, or it could also be a combination of the two. Now, the other key difference in CBDC is also the role of the central bank. Now, in certain countries, and I'm glad we have IMF speaking at the onset just now. There's actually a survey done by IMF in 2020 where the role of central banks can be seen as either the full spectrum, meaning as issuer, distributor, payment system provider, and the user e-wallet, or a combination of two or three of the above, or just mainly issuers, right? So that is actually the big overview of what is the CBDC in terms of the landscape. Just to give a bit of background, PayNet is actually the central payments infrastructure for retail payments in the country. We studied CBDCs in October 2021 on an in-depth basis. At that point in time, there were only 83 countries that were looking at CBDCs, 81 of which, as Dr. Abdelilah mentioned just now, representing over 90% of the global GDP, is seriously considering it to have cancelled Since then, we are looking at from 5 issuers in October to I think now we have 11, right? And some key statistics there is that they're all intermediated, they're not direct, they're all retail, there's only one cross-border, and they're from developing countries. None are actually from developed countries. And in as far as the use cases that we see, there's a good research paper done by the Bank of England where they see 7 specific use cases in the issuing CBDC. The first is actually to support a resilient payment landscape, meaning they see some gaps in the current payment landscape, and they see CBDC as a good or potential solution that could address CBDC. I mean that particular gap. The other one is actually to avoid the risk of private money creation, which is stable coins, in other words. And the third element is to kind of like support efficiency and to look at areas where there is innovation in payments. When you have CBDC, you actually exploring new technology, new ways of intermediation, and therefore there's actually area where you can scale some kind of innovation to address known problems in financial access and inclusion. Now, the next one is actually to meet the needs of digital economy. And with digital economy, you need to be online. You need to be able to intermediate payment quite quickly in real time. So CBDC is seen as a good, alternative or solution. The next one is actually to improve availability and usability of central bank money. In certain countries, central bank money is not the main currency of choice. It is used together with reserve currencies such as the US dollar or the euro, and therefore having CBDCs would expand the use in terms of the breadth and depth of the availability. The other bit is that, and this is more common in developed economies, you see situations where there is a decline in cash usage and you don't want to be issuing fiat money in its physical form. CBDCs is seen to be one of the options that's being considered. And lastly, which is a more pervasive and prevalent motivation to use CBDC, is for cross-border payment. Because when you look at cross-border payment today, the traditional correspondent banking framework is taking days to transfer money from one jurisdiction to the other. Using CBDC or multi-CBDC platform would disintermediate that particular leg and increase the efficiency, and among the things that G20 actually had place focused on, and that was augmented by FSB, Financial Stability Board. And several countries are seriously looking into it, including Malaysia. So maybe I'll just stop there to just give that big overview on CBDC per se.
Thank you so much, Mrs. Lina, for this brief and concise overview that touched upon a number of aspects related to CBDCs, including actually the operational mechanism. But now we will dive deep into the details regarding the CBDC models and operational mechanisms. And for that, I will call upon our second speaker, Mr. Mustafa Said, to cover this point. Mr. Mustafa, the cloud is yours.
Thank you, Rachid. And Assalamu alaikum warahmatullahi wabarakatuh to all of the prestigious audience members and my esteemed colleagues on the panel today. Just want to thank the CIBAFI for the opportunity to present on today's discussion. So let's kind of dig deeper into some of the comments that Lina actually did a very good job in explaining the kind of operational mechanisms, the kind of model aspects when it comes to the design considerations of CBDC. But before I do that, let me just provide maybe some context which would derive and obviously help distinguish the design considerations of some of these mechanisms. So before I start, there is a quote by Sir John Cunliffe, Deputy Governor of the Central Bank of England, and he stated that for forms of money should adapt to the way that we live, rather than the way around. So what that basically means is that as our lives have changed over the past few years, and it has been obviously rapidly, I suppose, increased by the kind of crisis that we had over the pandemic, this has led to the newer needs or aspirations of public people when it comes to money. And I suppose CBDC is a natural kind of paradigm shift in the way that the public want money in a digitized form. So I think that's an interesting kind of starting point before we kind of look into the kind of whole aspect around how CBDCs need to be designed and modeled. So my particular presentation will cover a number of areas. So we'll quickly touch upon the distinction between the implementation models, which is retail versus wholesale. We'll talk about the kind of model design choices, which was mentioned by my previous presenter, which is direct, indirect versus hybrid. We'll talk about the count versus token. And then we'll briefly then finish up with some of the operational mechanisms to ensure a CBDC like this can be implemented in a particular jurisdiction. So let's start with operating model. So there is a clear and succinct choice, right? It's either wholesale or retail. And often when it comes to a central bank making a decision on which particular option to choose, those are often the first questions that are being asked by central banks. So I think Azina has done a pretty good explanation of that, so I won't spend much time on this. But when we talk about wholesale and retail, we should consider one other thing, which is that, as stated by the BIS, there are some certain principles that we should consider, and these principles emphasize the following points. So when we decide on whether we adopt or design a retail or wholesale CBDC, a central bank should not compromise monetary or financial stability. So that's number one. The second point is that this particular CBDC, whether it's retail or wholesale, should coexist and complement with existing form of money, which is quite an important topic for many of our audience members today who work within the commercial sector. And then lastly, a CBDC should promote innovation and efficiency. So why are these particular principles important is that when we start talking about which model to choose, whether indirect versus direct, whether we go for an account or a token, whether we should start with wholesale versus retail, these particular core principles as specified by the BIS should be at the back of any central banker's mind when it comes to designing the instruments for CBDC. So it's important that we discuss this. Now, we've discussed wholesale versus retail. Let's kind of maybe dig a little bit into detail on this. So a retail one, as explained by my previous presenter, is the one that will be issued for the general public. Often it's referred to as general purpose, and a retail CBDC could be designed either on a DOT or a non-DOT solution. Ultimately, the features of those particular different solutions can offer different advantages, but ultimately it's been cited in a number of different literature that a DOT-based approach could offer a number of different advantages. And these advantages can include anonymity, traceability, availability 24 hours a day, operating 365 days a year, and a retail CBDC could potentially also offer programmability functions that could offer additional functionalities, which could be interest rate applications, for example. Now, the retail proposal would be largely popular for emerging economies, primarily because of the motivation of retail CBDC offering, financial inclusion benefits. And obviously, we've also seen a natural progression in terms of a shift to a cashless-based society. And so, this could also offer a great advantage in this particular regards. Before we talk about wholesale, the other principles I would like to add, which was obviously previously covered by my colleague, is that when we talk about the design of a retail or even a wholesale CBDC, one should consider a variety of other technical considerations. So a retail CBDC should be launched as a new form of central bank money. So in order for that to be a central bank money, that CBDC should be issued, managed, and controlled by the central bank. And the supply of that retail CBDC would depend on the monetary policy of that country. So it's important that when we design that, that is one of the first considerations. The second thing is that, as mentioned by my previous colleague, retail CBDCs fall under the liability side of the central bank balance sheet. So that's an important distinguishing trait when we compare it to other kind of forms of digital money. Also, we need to understand that a retail CBDC should be accepted as a legal form of tender. It should be a mode of payment, and it should be a safe store of value. And then lastly, it should be distributed one-to-one in parity with the relevant fiat of that particular jurisdiction, and it should have a 1-to-1 ratio with the fiat currency of that particular jurisdiction, so it's easily convertible. So these are things that should be considered when we talk about retail CBDCs. Now, on wholesale CBDCs, it's probably relatively straightforward, but wholesale CBDCs isn't one that will be used by the general public. It will be ones used by financial institutions that hold reserve deposits with the central bank. Now, obviously, wholesale CBDC could be advocated and used to improve payments and security settlement, and it could help it make the entire process more efficient and help obviously reduce counterparty risk and liquidity risk. But it's also important to note that a wholesale CBDC, from a conceptual standpoint, shouldn't be a new thing. So, as recently stated by the ECB, it was highlighted that the notion of CBDC from a wholesale standpoint isn't an entirely new thing. A lot of central banks, in particular, as we've seen in America with Fed now, and obviously with the ECB, with the target system, they're working on ways of improving the technical infrastructure of their current wholesale landscape. And so what they're saying is the conversation that has been driven CBDCs from a wholesale standpoint isn't entirely new, although they're advocating that improvements can be made, and they're looking and willing to examine the benefits that could be adopted and offered by DLT solutions. Now, in my view, the wholesale approach could be seen as the natural first step for any central bank. It's probably the more easier one, less invasive from a technical standpoint, and less disruptive. And I would also argue that the benefits that could be offered on looking at the wholesale option compared to the retail one would be more, quickly enabled, right? So when we talk about the global payments being quicker, cheaper, and more secure, wholesales can enable that, right? Because it has that element of, enabling cross-border payments. So from my point of view, it's argued that that could be a quicker win, and it's one that I've seen within my discussions with regulators and central banks within the Middle East that has interested them the most. Now, let's talk about quickly direct and indirect, because I know my previous panel had discussed this, but the next thing after we've discussed about retail and wholesale is about direct and indirect issuance. So direct issuance is all about a CBDC representing a direct claim on the central bank. So they keep a record of all balances and unpaid when a transaction takes place. So this is very, very important, because this is a profound change that we're seeing with CBDC currencies that we don't see under the current system. Now, under the indirect model, the consumer has a claim, but on the intermediary, and the central bank would keep a track of all the kind of wholesale accounts. So slightly different, but there's a role of an intermediary that could take that particular role. The direct CBDC is attractive from a simplicity standpoint, because it obviously it eliminates the dependence of intermediaries, and it could do away with them. However, this doing away of intermediaries can compromise payment system reliability, speed, and efficiency. So it's one that requires a lot of thinking, a lot of further kind of insight and discussion. And it's also one that has been often, the one that central banks kind of veered away from my discussions with them in the Middle East. Under the indirect model, and it's often also referred to as two-tier, that is somewhat slightly different, because for consumers, this is a type of CBDC where there's no direct claim on the central bank. It is the one that maybe banks would be more open to consider, because an intermediary could take a middle approach, and this could take a close resemblance to the narrow payment banking system. So there is more interest on the indirect approach compared to direct. Now, there is a third approach, which has been cited in literature, which is the hybrid approach. And as explained by the definition, it is a hybrid of both direct and indirect. Now, on the hybrid approach, there are direct claims on the central bank, but it enables intermediaries to handle payments. In addition to the previous pure options, there is a novel solution that could, merge various technical components of both the indirect and direct approach of CBDC, and that could be considered. One other key element of the hybrid CBDC architecture is that there should be a legal framework that underpins how the balance sheets segregates the movement of money. So, for example, if there's a role within the hybrid framework that allows PSBs to play a role, then there needs to be a clear legal framework that segregates that particular aspect. I am not a legal guy, but I'm a technical expert, but I'll defer that to my colleagues if they want to touch upon that. Now let's quickly move on to the whole account and token discussion. If you read a lot of discussions about account and token, it invokes a lot of discussion. And from a technology standpoint, there is a clear distinction between what account and a token should be. But when you look at the definitions of what an account and token should be from a central banking standpoint, that often leads to a lot of dispute and confusion, because central bankers often they don't really see the distinction between account and token, because inherently two of those components often exist under the current system. But from a technology standpoint, I think it's quite clear, because when you read some of these papers, when we talk about account, as mentioned by my colleague, it talks about verifying the identity of the payer. Whereas when we look at a token-based system, we're looking at the validity of the object used to pay, hence the token. So there is a clear distinction. But when it comes to the commercial banking technical vernacular standpoint, there is a bit of a confusion, but we won't kind of go into that because there's a bit of a semantic dialogue. A token obviously represents a representation of an asset. So when we talk about token, it's a very prevalent discussion, in particular when we talk about blockchain, because assets on the blockchain are tokenized. And so when people talk about a token-based approach, we're often looking at a blockchain-based solution. Now, unlike an account-based system, the liabilities would not be stored on accounts as per the traditional system. However, liabilities will be stored in accounts at the central banking level. Now, obviously, when we talk about tokens, there is a concept around the usage of wallets, and that wallet usage is very similar to what we've seen with cryptocurrencies, Bitcoin and Ethereum, for example. From an account standpoint, it's very similar to the traditional aspect. The central bank would hold accounts for users who want to basically receive CBDCs, and the central banks would hold accounts for all users, and this would mean an exponential growth in handling more users over time. It is not one that I've seen local central bankers that I've been speaking to in this region consider, but it's nevertheless some of the model discussions when we talk about this particular topic. Let's quickly move on to the last point, because I know I'm running out of time, which is on we talked about indirect and direct. We talked about wholesale and retail, and we talked about account versus token. Let's talk about some of the kind of operational mechanisms. So there is an argument on how we can deliver a CBDC. Now, we can use traditional rails, traditional infrastructure, as mentioned by my previous colleague, or we could move to the more DLT-based solution, which has been presently examined by a number of different central banking organizations across the world. There are a number of central banks also working on prototypes to assess and evaluate whether a DLT solution could be resilient enough to handle their local CBDC system. But progress to date on such a DLT solution hasn't been met with much widespread acceptance. And the reason why is that, in order for you to leverage a blockchain solution from a purist standpoint, you really need to look at more public-based solution, whereas often a private permission-based iteration of that particular open source public chain technology doesn't often give you the advantage that you need. And as we all know from a money issuance perspective and from a central banking perspective, an open source public permission-based public blockchain technology would not be acceptable. And so there's been that kind of issues that I've experienced from some of my dialogues with other central banking providers in this particular region. Now, if we were to consider DLTs, of course, we could look at private permission iterations, and private permission iterations could be used not just from a retail, but on a wholesale perspective, and that wholesale perspective could help, address some of the kind of real-time gross settlement systems that we've seen, which includes CHAPS, Target, Fedwire, and so forth. So, there is a clear role that the technology could offer. But from my technical understanding of the technology, it's still relatively nascent. It's still relatively prone to a number of issues that we'll see considerable changes over the foreseeable future. Now, my closing remarks before I head back to Mr. Rachid is that from an operational mechanism standpoint, there are a number of things that we need to consider. Now, regardless of whether we use a DLT or a non-DLT solution, things that need to be considered from an operational standpoint is system management, wallet account management. There will be broader account ecosystem services that need to be considered, and governance. Now, what do we mean by these four? I'll be very quick. From a system management standpoint, we would need to consider how the core ledger and infrastructure needs to be maintained. From a wallet and account management, we would need to consider some of the processing services, as well as how we would need to manage accounts in the core system, be it DLT, non-DLT. There would be broader ecosystem services, and these could include the services that could be bestowed upon merchant providers, payment gateway providers, as well as programmable services and user interfaces, for example, mobile applications. And then there would be lastly governance considerations. So there will have to be processes, right, in terms of how decisions are made on the structure. If you look at a DLT-based solution, if it's a private-based solution, how's consensus on the validating transactions going to take place? How are the capabilities and technical features of a CBDC need to be made? So there's a multitude and a plethora of complex conversations, and I think this will lead to a lot of dialogue in the foreseeable future within the Middle Eastern market. I'll take a pause. I think I've gone on over my 15 minutes. Mr. Rachid, over to you.
Thank you so much, Mr. Mustafa, for this detailed intervention of yours. Actually, I can see that there are a number of things that are related to the technical aspects of CBDCs, and you did a great job in structuring that in 15 minutes. So now we will move to one of the things that I consider perhaps the one of the evidences for showing that CBDCs is really an important topic, is when we see central banks taking actions in this regard. And to cover the current use cases and the prospects and all the different the ongoing projects, we will call upon Ms. Anur Kanziyeva to give us more details on the different use cases that exist now in the market, with a focus on the ongoing projects under the National Bank of Kazakhstan. Ms. Anur, the cloud is yours.
Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you for passing me a floor. I'm very pleased to have this kind of advanced question regarding CBDC. And just to grasp the attention of the listeners, allow me to share a few slides. I wanted to explain conceptually how we see specifically like the use cases. I will try to stick to this specific topic. I will not cover everything that was mentioned before regarding our goals or definition. Just let me to explain why this topic is very difficult from the first standpoint. Whenever we talk about the CBDC, like there is a high contrast between the demand from the market and what can do like our national bank or central bank at the beginning of the stage. We have started, for example, our journey from the last year. There are two streams of work that any central bank tries to do. First, they're trying to cover some basic requirements for any payment systems. Meanwhile, the market always tries to see which kind of value added will be from CBDC. It's not the questions that could be answered at a very short period of time. It's a very complex thing. And I just wanted to demonstrate why we see it's very complex and to share our vision regarding these use cases and regarding which kind of value added could be from CBDC. At the beginning, for example, any central bank like Kazakhstan trying to build up this basic infrastructure which satisfies requirements to resilience, throughput, some cybersecurity questions. Meanwhile, we are developing this basic infrastructure. We're also laying the second field, which covers value and overlays. For example, it's specific features of our digital tenge. We know that every country has its own goals and every CBDC has its own features. In our case, for example, in contrast to other CBDC, we have high level of anonymity in contrast to existing cashless payments. We have allowed all of our rights to user sites that can only user decide who can see their transactions. We have built up this kind of design features in our CBDC. Digital tenge is the second layer. We have also tested some kind of offline protocols, programmability, smart contracts. And what we are talking about here, the question which relates to use cases is the third level. It's the third level that could be developed by market participants. It's like last mile. For example, whenever we'll finish to build up this basic payment infrastructure, on top of that, we'll add up some features of CBDC. We'll give this infrastructure to market participants, and using all of this available infrastructure, they could add up some kind of specific use cases. And the success of the use cases depends on this level of adoption. like network effects. If that use cases will be highly adapted within these kinds of some territory or among the society, it will gain a value added. What we'd like to deliver is that value added from use case of CBDC depends on the adoption level. Furthermore, I will give some kinds of practical implementation and some specific use cases that we are also considering here. In the practical terms, how we can achieve this third level of work with market participants, how we can achieve this kind of use cases from market participants. Every central bank chooses its own way of doing investigation, this research. Some do it in a closed environment, but we from the beginning understood that the success of CBDC depends on the development of ecosystem, of the engagement of the market. And for example, when we first published this consultative report that only defines what is digital tenge, and when we did this pilot phase, did a lot of technical research and technical, we did some technical feasibility questions, and we have proved that all of our design could be done within this POC mode, and we did economic and regulatory aspects. But in each of the stage, we engaged our market participants, banks, fintech companies. We do a lot of this iterative explanation work, so that from the last year, they are not like asking us what is a digital tenge now. They are now more informed than their, and this year, for example, we have continued our work with our market participants to gather advanced use cases and smart contracts. We have launched, for example, Digital Tenge Hub. It's a collaborative platform that allows us to work with our market participants. Within this platform, we train them how to write smart contracts. We discuss them a lot of questions that was mentioned before by a previous speaker about the operational models. We discussed a lot of regulatory questions. We're doing all of this in a transparent manner so that all market final intermediaries who will deliver these use cases to the market, not the central bank, will understand the specific features and benefits of the CBDC. Here, just like highlighting which kind of two streams of work we are doing. The first stream of work is building some kind of platform like many other central banks. The second stream of work is related to these advanced use cases in a closed environment, R&D sandbox. It's more like, for example, by October, in next week, we're launching this pilot phase in a friends and family mode. We're developing, testing all basic life cycle scenarios of the digital tenge, from the issuance to the redemption, and using some programmability features. And the second stream, R&D sandbox, it's isolated environment where we're testing this kind of developed smart contracts. For example, like a month ago, we have launched Ideathon. It's a competition for different kind of use case scenarios. We have gathered a lot of ideas from our market participants. We are discussing them and developing, and we'll develop them in our R&D sandbox and different kind of these smart contracts. The first stream, as I have mentioned, it's a first basic life cycle scenarios. Meanwhile, the second R&D sandbox mode includes these kinds of top group of use cases. They can be gathered and grouped and classified in different categories. For example, in our R&D sandbox, we're testing the chain of offline payments. Last year, we were able to test a few of them. This year, we're extending the number of transactions in a chain. This use case is very vital, for example, in our country as well, because we have some remote areas where internet is not stable. The second things that we have, for example, tested last year and this year, we're developing more advanced ones related to government social payments. We understand that CBDC could allow to give can boost the efficiency of government payments. It allows to trace and to limit these funds to certain type of services and categories, groups of products. There are a lot of use cases that we are also discussing, for example, peer-to-peer. It relates to deferred payments, sometimes limiting the use of funds, or possibility to change the card user without the reassurance, and tracking the intended use of charitable funds, which is very vital in any country. In case of the B2C, which could be highlighted, pay-as-you-go micropayments. For example, we have some kinds of energy use or some other that could not be split it in a micropayments, but meanwhile CBDC and the integration with IoT M2M allows us to have these micropayments pay per use. GTC, as I have mentioned, it covers some like tax related. For example, there could be some scenarios where like value added taxes could be immediately sent to budget at the moment of these payment transactions, because CBDC allows it to compensate and to track all of these funds at the moment without any like additional papers and or like reports, other things from different intermediaries. Conditional use, like limiting the use to, as I have said, what we have tested last year, limiting the use of funds to some type of services and products. And B2B, when we talk about that, like payment suppliers could be supplied only like all conditions and terms that were predefined will be done, will be like satisfied by different parties. Only after that, the suppliers could be delivered. And the other case also include like programming roles for different stakeholders within this wallet and automatic transactions for like contract terms. There are a lot of like cases that could be discussed for CBDC, but the main thing which I wanted to highlight here, like central bank function is to deliver all of the infrastructure. It's not the role of the central bank to like generate all of these use cases and ideas. The role of the central banks to give this infrastructure to market participants to build up on the second layer the features of CBDC, and all of these like common infrastructure, common features will be available to everyone, and like final market participants, fintech companies, banks, and the intermediaries who well know the needs of the consumers will develop and foster these kind of use cases. And in the practical terms, we're trying to develop this ecosystem from the beginning of our research. Thank you for your attention.
Thank you so much, Ms. Inur. We have covered in the discussion as of now a number of points regarding the definition, overview of CBDCs, the technical aspect, and also the current use cases with the focus on the use cases of the project of National Bank of Kazakhstan. And I think now one of the most obvious questions or straightforward questions that anyone would ask is what are the benefits and what are the risks related to CBDCs? In the keynote speeches, the speakers highlighted a number of points, for example, in terms of benefits, providing cash in digital form, improving efficiency and domestic payments, enhancing financial inclusions. But there are also some challenges that are related to macro economic, financial, and operational factors, like, for example, cybersecurity or the maintenance of the system that backs these CBDCs. So now I will go back to Ms. Abdelilah to emphasize on the impact of CBDCs on the financial sector, focusing on the key benefits and challenges. So Ms. Abdelilah, the cloud is yours again.
Thank you very much. Well, the thing is, when we look at this particular, question, the biggest issues that would stem up is actually what are the implications to the general economy, and you can actually dissect that into several permutations. The first being is the implication to the monetary policy itself, right? So monetary policy in essence is actually about price stability. And you're looking at, whether or not there will be a risk of financial disintermediation or narrow banking or credit squeeze arising from, the transmission of policy rates to money or credit markets, right? So you may have a situation where if you have two coexisting currencies, CBDC and the fiat money, that's not well linked, there may be some monetary transmission issues. That's one, right? Second is actually financial stability. Financial stability is actually about, in plain terms, intermediating capital and savings well and efficiently, right? Now, there is actually where the risk of, whether or not there will be bank runs between cash to CBDC or vice versa, if it is not well managed, and if there is no one-to-one parity between CBDC and the fiat currency. Now, the third element is actually the impact to the financial system itself. Now, if you're not using the traditional rails, then people like payment services providers, banks, financial institutions may risk being left out of the financial system per se, right? And therein lies the risk, the inherent risk, which central banks must look at in order to weigh the merits and demerits of using CBDC, right? So let's now look at the benefits of using CBDC, because now I've covered on the risks. Let's look at the benefits. Now, in the countries that have issued CBDCs, they have been particularly successful in ensuring financial inclusion, right? The first country to ever issue CBDC was Bahamas, right? And they issued the sand dollar. The sand dollar was issued on a hybrid basis where it has offline, online kind of capabilities, and they even created something called the CBDC Wi-Fi, right? It actually started after I think Hurricane Dorian struck the island. It has very wide, expensive land area. ATMs were completely shut, and money is not giving it's not making its way under the traditional sense to all these islands. So in comes this pilot project where IMF came in, worked with another technology company, and started issue together with MasterCard this particular card, which allows online offline capability issued through an intermediary, and money got sent to the hurricane struck areas, and was scaled quite quickly to the rest of the Bahamas. So if you look at that particular situation, financial inclusion was served in a manner that could never be served had we waited for ATMs to get back up, electricity supply to come into the picture, so on and so forth, right? So that's one area where CBDC actually played a very strong role. Now, the other two countries that we saw, which is actually the Eastern Caribbean Currency Union, Jamaica and Nigeria. These are all countries, again, that were issuing it out of financial inclusion and financial access considerations. So, again, I would go back to the point that was raised by Ms. Ainur. The use cases is actually the one that determines the benefit and the merits and demerits of CBDCs. And from there, you should dovetail to Mr. Mustafa's point just now, in the sense that, if you want to design it, it has to be designed based on the use case that you are looking to address, the kind of pain points that you're looking to look at, in order to bring about the benefits of CBDC to its fullest potential. Now, for central banks, what they would normally look at is actually, does that or does the issuance of CBDC achieve the central bank objectives? And not all central banks have got a combination of financial stability and monetary stability. Some just have only monetary stability. Some just have only financial stability. And some may not even have things like, financial inclusion, financial access, consumer protection, economic growth, or addressing economic inefficiencies in their mandate. And therefore, there is actually a general reluctance for these central banks to move away from those kind of use cases in order to bring forward CBDCs. Now, from a country-specific designs, key considerations that that central banks will need to look at is also the issue of, I would say, performance. Because in countries where there is already a very established, traditional rails, the performance of DLT can be very limiting. Now, a case in point, if we were to use, for instance, Visa, right? There is such a thing as what you call TPS, transactions per second. Visa typically, processes something like 65,000 transactions per second, right? But if we were to use a private DLT, I think this is the figure that I got from what I've read. It's around 20. So 20 versus 65,000 is like considerably, a huge gap. And even if the speed is improved, you're looking at a max of 10,000 TPS compared to 65,000 TPS under the normal rails. So for developed countries, no prizes for guessing that they would tend to shy away, to replace CBDC in favor of retail payment system. They would tend to stay with what is more stable and what is more resilient and known to be performing up to the speed and to the demands of the economy. Now, the other area that is actually also a challenge for central banks to consider is from a resilience point of view. If you look at DLTs, distributed ledger has many points. The cons or the disadvantage is that you can suffer from multiple points of failure or multiple vulnerabilities. But on the other hand, if you compare that to central bank centralized payment system, one point of failure would result in the collapse of the financial system. But then if you have a DLT, you have the other nodes to actually complete the transaction if need be, right? So in other words, you're looking at having a more on the one hand having a more resilient system because of multiple access. On the other hand, exposure to vulnerabilities because of the cyber risk that it invites due to the multiple potential points of attacks, right? Now, the other bit about it is also when it comes to cyber attacks itself, because of the distributed nature of, and I'm seeing more of a permission DLT type of situation, because there is actually multiple ledger involved. Any cyber attacks would have to attack all those multiple ledger in order for it to collapse, right? As opposed to doing a single point of attack. So that's where there is some kind of potential benefit there, right? So yeah, and I suppose the last point where it could also be a challenge is because when you start using tokenization and what you call an anonymized system, AML CFT comes into the picture, and you can't really validate certain things to a certain extent, and that's where regulators don't sleep at night. But on the other hand, if you have a system that's already identity based, and because it is central bank digital currency, the fact that it is actually digital, and the moment you start to use it on a cross-border basis, another argument comes into the picture, which is actually digital identity. Now, you would necessarily need to, as what we have uncovered in our experiment of Project Dunbar, a mutual recognition of each other's digital identity framework, right? So if you want to have that to be successfully done on a cross-border basis, some kind of mutual recognition or interoperability it needs to be in place, right? So yeah, I think from a financial system stability, from a monetary stability, and from a monetary policy stability, those are the considerations. Now, on the impact to financial institutions, it all pretty much depends on the design of how you're going to do your CBDC, as well as the role of the central banks. Now, if the central bank goes on a direct model, it means that there will be total disintermediation, right? So then, where do you will end up displacing the role of financial institutions. If you go on an indirect model, there's still a role for the providers, and there is still some kind of intermediary role that will be played. And there's also talk about going on a hybrid model, which again would involve to a certain extent the intermediaries role. Now, so in essence, where we're coming from is that we need to be looking at these implications as well. And you cannot transition immediately to a model that completely disintermediates, which actually explains why two of the more advanced countries where cashless is actually very, very high, namely Finland and Denmark. If you look at the way they approached CBDC, Finland did that in the 1990s, considered it, looked at it, revisited it, later on, and decided, no, that's not for us for the moment, because the system is still is efficient enough. So did Denmark, which in 2016 started to kind of like explore it with the e-krona. By December, they concluded that the potential benefits of CBDC for the household and businesses in Denmark would not match the considerable challenges which the introduction of CBDC would present. So, that was the conclusion made by them. I suppose, they were thinking that despite the efficiency gains of CBDC, it does not outweigh the financial instability risks, of systemic bank runs that may result with the e-krona. So by contrast, are the findings of more developed countries. But for the lesser developed countries, the story may not be the same. Especially when you have a financial system that has underdeveloped financial intermediation, inefficiencies in transmission of money, or financial access or inclusion issues, just like the two cases that has gone live that we've seen, right? So maybe I'll just stop there. Thank you.
Thank you, Mrs. Lina, for this detailed coverage of the benefits, challenges, as well as the impact on the financial sector of CBDCs. And now I will pass on the cloud to Dr. Haziq Mohammed, and I will kindly ask him to respond, provide us details on two questions, actually. In case the financial sector wishes to embrace CBDCs, what will be next for those that are already having some pilot projects ongoing and countries that are still behind? And the second question, in case the intermediary banks have a role to play in this, including Islamic banks, what will be their role, and how can they prepare themselves for this? Dr. Haziq, the cloud source.
Thank you very much for this invitation on such a important topic. I'm happy to be part of a distinguished panel of speakers. And the two questions that you posed to me are definitely worth looking at. We already know that most of the central banks are looking at CBDCs. They are testing and they are experimenting. They are looking for a solution that is not available from the system that they have. And they are trying to assess the CBDC to see if they can find solutions there. Dr. Tausen from IMF earlier opened the discussion. He said that one of the problems that CBDCs are facing is the low adoption rates. So I think it is besides knowing when we deal with technology, we need to understand the use case that we want to use it for. We also need to know that the market will decide the solutions that we want to provide or we are working on, whether they want to use it or not. So hence the adoption rate. So that's also another very important factor that we need to consider. The CBDCs can be applied in various formats. I've covered this in one of the chapters of my book, Beyond FinTech, that was published in 2020. there were four main categories. Number one, to use CBDCs as cash. Number two, to use CBDCs as a public deposit at the central bank. Number three, as a tool for monetary policy, which we have covered a lot today by the different speakers that we have. And lastly, as an interbank payment system, which is what has been referred to by the other panelists as wholesale applications. So the cash applications will be known as the retail applications. So CBDCs has been touted as a game changer because it will provide an alternative payment solutions for citizens as well as corporates. And it has the potential to reinvent financial market settlement and interbank monetary transactions. So some governments, as we've discovered today from the other panelists, they are prioritizing wholesale or interbank type of applications, while others are working on retail applications such as to be used as digital cash or another form of e-money. So for retail CBDC development, retail CBDC initiatives are particularly strong in emerging economies, where financial inclusion and digitalization appears as key drivers. So Ms. Azlina has brought up some very specific examples that was clear for everyone to understand. She highlighted the Cent Dollar by the Bahamas. Cambodia is working on their own version of CBDC called Bakong. Of course, China is working on the digital yuan or renminbi, whatever you want to call it. The Ukraine was actually working on e-hryvnia before the war came. I don't know how it's going on right now. Uruguay was working on the e-peso. Ecuador was working on dinero electrónico. Eastern Caribbean working on Gcash. Sweden on e-krona. South Korea on e-won, and of course Turkey is also looking at under the program of Digital Lira. So the Digital Yuan project, just to highlight, was done by China. It has already reached an advanced level of trialing, which is why I wanted to highlight it, with more than 2 billion yuan, which is about equivalent to US 300 million worth of transactions, and are reportedly preparing a broader usage at the Beijing 2022 Winter Olympics later this year. In the most recent reports, Beijing said the digital yuan has been tested in more than 70 million transactions worth over $5 billion US as of July 2021. So current numbers will definitely be much higher. So the entities that have been involved in such trials included some of the selected commercial banks and MNCs such as McDonald's and Starbucks. So that's for the retail segment of CBDC development. For the wholesale interbank CBDC development, advanced interbank projects have on average shorter research stages than the retail counterparts, but they tend to have longer pilot stages simply because of the immense number of stakeholders that are involved. Cross-border projects make up the majority of the most advanced initiatives, allowing central banks to test cross-border connectivity and project interoperability. These examples include Hong Kong, between Hong Kong and Thailand, between Singapore and Canada, between Europe and Japan, and between UAE and Saudi Arabia. So most advanced interbank or wholesale projects are expanding their scope to evaluate interconnectivity with other interbank projects or the potential of linking within, in between, or across retail projects. The repercussions of the CBDCs in different formats will affect the way central banks, financial institutions, and consumers interact with one another, changing the way financial services will be delivered in a significantly transformed financial landscape. Moving forward, the implications of CBDCs need to be carefully studied and tested before any format or combination of formats are eventually implemented. For example, the entire GCC market is essentially still a cash-driven economy, and the digital versions of sovereign cash will likely dominate their daily transactions for the next decade, just like ASEAN, here in ASEAN in Southeast Asia. CBDCs in the cash format may replace digital cash, but the impetus for the GCC or ASEAN, these regions to issue their retail CBDC need to be compelling. Project Ubin was Singapore's wholesale interbank CBDC undertaking, which successfully explored the commercial applicability, viability, and benefits of the DLT system across the finance industry beyond capital markets and trade finance. However, the different formats of the CBDCs pose different challenges when they are implemented, especially as a hybrid for multiple use cases and purposes. This is because different implications and consequences will result from the different formats that can be implemented. Hence, Islamic banks, since we are speaking about Islamic finance today, need to be aware of such implications and consequences. So what are these? For example, if retail CBDCs are implemented, retail versus wholesale, the retail CBDCs are implemented, it will significantly affect banks' payment business. Faced with bank fees, no matter how minimal, even people who prefer traditional banking accounts would consider converting their deposits to frictionless CBDC for more efficient payments. International transfers that charge fees are already affected, as we already know and see. When you have fintech options that virtually don't charge any fees, that is. But banks would probably continue to offer payment services as part of an encompassing service of financial management to remain relevant. Also, asset and liability management by banks would be more difficult. If consumers decide to keep savings in their wallets using the CBDCs and outside the formal financial system, deposits in the banking system would fall, and as well as the money multiplier and credit creation. Consequently, the banks would lose critical data that they traditionally use to draw up credit scores based on consumer wealth and repayment behaviors. In addition, the banking sector would face the entrance of new, potentially less regulated players. New entrants would probably start with services in payments business and would eventually broaden their scope to eventually offer credit and full-fledged alternatives to deposits. For the finance industry as a whole, a CBDC means increased efficiency in payment and transfer systems. Also, if banks safeguard the passwords of wallets and decide to do so as an extended service that they provide to remain relevant, new businesses could emerge based on this type of service, as Mustafa Said had pointed out towards the end of his session. However, if there is a reduction in deposits and the central bank does not adopt compensatory measures, it is most probable that commercial banks will need to find additional capital from the financial markets or by other means. In the wholesale interbank CBDCs version, the creation of a shared payments ledger system would allow for real-time and traceable transactional information about capital flows, which is progressing towards a dynamic type of monitoring and better management of systemic risks. Furthermore, the central banks will have to compete with other digital currencies or ledgers in order to keep full control or have complete supervision of the settlement system. In fostering competition, it will expand accessibility without incurring traditional payment infrastructure costs. The marginal cost of adding a new participant will be considerably lower. Adding a new node to the network is technologically and operationally simpler and, of course, cheaper. However, Tier 1 banks would lose their privileged role as ultimate settlers in central banks' accounts and will lose part of the payment business to Tier 2 banks or non-banks or even fintechs. Additionally, direct access to the wholesale payments settlement system would allow non-banks to provide end-to-end payment services and consequently increase their market share. Such new entrants might negatively impact the revenues of traditional banks. However, the benefits in terms of efficiency, infrastructure cost savings, resilience, transparency, and innovation could well outweigh such loss of revenues. This format would further push banks to focus on the credit business, where they would maintain a competitive advantage, mostly due to both their expertise in risk management and the resources needed to enter into this type of business, in the financial services business. Anyway, given the important role that non-banks will have in the new competitive landscape, potential partnerships between banks and non-banks could naturally arise, and the aim of complementing knowledge, skills, and processes to build a win-win value proposition in payments and credit services. From an operational point of view, this scenario would force banks to excel in management of their CBDC wallets, if they choose to provide such services, because pre-funding of wallets is mandatory in a distributed ledger-based system, which would mean the banks cannot operate in overdraft. Central bank settlement accounts in RTGS today are quite similar, as they are periodically pre-funded with accurate calculated funds enough to cover the payment needs. However, in this scenario, banks need to balance the amount of central bank money both in the traditional form as well as in the CBDC at all times. For banks and Islamic banks, the utilization of a distributed ledger-based infrastructure allows for the full availability, as Mustafa also has pointed out, 365 days a year, 24 hours a day, 7 days a week of the system, which can operate without interruption, unlike the current RTGS systems, such as the Target 2 in Europe, which have a predetermined operating schedule. In addition, a decentralized system is much more resilient to potential cyber attacks because there is more than a single point of attack in order for it to fail, as opposed to a centralized system. Additional benefits would be speed, cost of efficiency in the whole settlement process, including infrastructure costs. Also, for Islamic banks, the value creation in the payment business would have to be based on a seamless and intuitive user experience and a broad range of value-added services, mainly built upon payment insights and knowledge extracted from the transactional data that they will accumulate. The end consumers will benefit from the cheaper, safer, and faster money transfers. In conclusion, for any CBDC to be practical, it would have to provide pragmatic implementable solutions that will solve existing problems that countries are looking at that cannot be solved by current tools and instruments. The impending structural change in the monetary system requires central banks to carefully consider which formats work for their needs and then implement them in a prudent, deliberated ways in order to mitigate risk and work out unintended and unforeseen consequences. That's it for me. Back to you, moderator, Mr. Rachid.
Thank you so much, Dr. Aziz. And I would like to thank all the speakers for their intervention and also the shared information. So before moving to the question and answer section, I would like to ask the distinguished speakers if anyone has any additional points to add. Please, the cloud is yours, but in 2 minutes, please. Perhaps I will start with Mr. Mustafa, if you have any additional points to add.
No, I mean, I could just finalize by saying a couple of quick points around some of the numbers in terms of, you know, the overall deployment implementation numbers, because I think that's a nice kind of ending point with me. And I think some of these have already been shared by my esteemed colleagues on this panel. But the IMF did a survey for their membership. I think it was last year or early this year, if my memory serves me right. It was an impressive kind of study. And out of their kind of survey, at that particular stage, I think early this year, they identified there was 110 countries at some stage examining or working on the research into CBDCs. Now, I know this is repeating some of the points that we already discussed, but this should tell you the magnitude of work and the breadth of work that's been undertaken by central banks across the world. This is definitely something that's going to continue to shape up and innovate and potentially, you know, change over the next couple of years. And so that's my first point. Number two, PwC did a similar study earlier this year as well. And our report identified similar numbers when it came to central banks. But we came up with some additional statistics, and some of the stats that came up in the report was that if we were to collect all of the total GDP of all of the countries that are currently working on a CBDC project, then the GDP would be 95% of the entire world's GDP. So that tells you the profound impact that, you know, a CBDC could make on the entire world that we're in. The other kind of number that I wanted to highlight was that 7 of the top 10 wholesale CBD nations are working on a particular project, and their particular project is an affiliation with the BIS. So what I want to make a point on that is that predominantly most of the wholesale projects that we see undertaken to date, more than 70%, have some kind of affiliation or cooperation being handled with the BIS. So I think the role of the BIS in particular within the whole wholesale space should not be understated. They're doing a lot of work. And lastly, if we want to examine the scale of the countries involved within the CBDC, and I think Dr. Haziq has already explained this, but I will just emphasize this again. The Atlantic Council, which is an online CBDC tracker, have stated that 19 of the G20 countries are all exploring CBDCs, with 16 already in some form of development or pilot stage. So I'm just trying to emphasize that these numbers alone are profound. They should give the audience some sort of understanding on the seriousness of the work being undertaken. And I don't think CBDCs are going to be fizzling out anytime soon. I think the future of digital money will be underpinned by digital currencies administered by central banks. Over to you, Mr. Rachid.
Thank you so much. Mrs. Lina, if you want to add any points.
Yeah, I would echo the point that Mr. Mustafa mentioned just now, in the sense that when it comes to the developed nations, especially the G7 and the G20, the Financial Stability Board, the Bank for International Settlement, the World Economic Forum, IMF, and World Bank, these are organizations and caucuses that's looking quite seriously into CBDCs. Now, specifically, what pain point are they looking at? It's actually in addressing the issue of inefficiencies in cross-border payments. So, there's a lot of collaborations. I think Dr. Haziq mentioned Project Ubin. There's also Project Jasper, Project Dunbar, Project ABER in the Middle East. These are all the projects that's looking at cross-border payments and making it a whole lot more efficient. Now, I would kind of like push back a bit in terms of the efficiency of DLT vis-a-vis retail payments, because as I mentioned, compared to traditional payment rails, where the payment is already efficient at around 65,000 TPS. DLTs are not as efficient at 10,000 maximum. Right now it's around 2,000 or 20 to be honest. It's more efficient compared to a correspondent banking or cross-border payment. It is faster in that sense, right? So to look at it from a perspective point of view, wholesale CBDC is being looked at by emerging economies, retail CBDC more by developed economies, and retail CBDC is more on the emerging countries where they want to leapfrog into digital payments. Now, the other thing is that it is an effective tool potentially, depending on how you define your use cases and how you design the CBDC to work. Thirdly, even though on one hand, there's issues about its benefits, we need to weigh the consequence as well, in the sense that with traceability, anonymity, and availability, there's also the risk of AML considerations, which if it is done on a collective basis, you can actually address those issues, right? So, and finally, when it comes to looking at CBDC generally, one needs to take an open view, and for financial institutions, we just need to redefine where we fit and how we support in this new digital economy. Because fintech, whether you like it or not, is already disrupting the cross-border payment flows. CBDC is actually just another enabler in that respect. So maybe I'll just stop there. Thank you.
Thank you, Mrs. Lina. Dr. Haziq, back to you, and then I will move on to Ms. Inur.
Okay, I just wanted to say that CBDCs and digital money would be another tool for Islamic finance to further implement the system that they had envisioned before. So if we're talking about to control credit creation, to improve financial stability, and to reduce volatility in the financial system, which we criticize in the conventional financial system. We could use this tool to develop a full reserve asset-backed, wholly owned, whatever protocol that you want to use, and you can implement that by implementing the format that you want using this particular tool through the CBDC. Also, there have been calls by prominent leaders in the past at OIC to have unified Islamic currency. The digital form of money in the form of CBDC could be a way to do so as a unified currency like the euro, and it could be implemented in such a way. In the second edition of the first book on Islamic FinTech, there's a chapter on that called Implementing the Digital Dinar, and we provide two constructs on how we can use distributed ledger system to actually do so. One through an aggregate sovereign construct, and another one as a basket of commodities construct. So it's something to also consider. Back to you, Mr. Rachid.
Thank you, Doctor. Ms. Senior, if you have any points to add.
Okay, thank you. I can just wrap up. There are also questions around CBDC that relates to economic risks, regulatory aspects, development of ecosystem, but all of that is not like questions of technology, economic, and other things. It's questions of our strategy and goals. And I think it's an iterative approach. Every time we just need to come back to our main goals, because everything could be designed in relation to our business requirements and in relation to and demand of our consumer needs.
Thank you. So we still have a few minutes left, so we will try to ask a few questions. And the first question is, how can CBDCs impact current payment solutions offered by big tech like Apple or Apple Pay or Samsung Pay? If anyone from the speakers would like to jump in and ask and answer this question, please. The crowd is yours.
Okay, maybe I'll start and maybe others can jump in. Well, when you look at what Apple or Samsung or Google or Android Pay is doing, that's a mode of payment rather than a currency. So you just store the payment mode onto your phone, and that enables payment, just like how you have plastic to make payments or QR to make payments. So in essence, it's actually using fiat currency in digital form using a different device. So in a way, it's not really comparable, but if you take it in such a way that if the digital currency CBDC were to be issued on a retail basis in a wallet available to the public, then there's nothing to stop it from being offered in Apple Pay or Google Pay or Samsung Pay or Watch or whatever. So yeah.
Okay.
Mr. Rachid, I'll add a quick point. The debate or discussion around big tech companies playing a role within CBDC can be seen in multiple lenses. So there is the first notion of whether these big tech companies will go alone and come up with their own form of stable coin, and how will that be perceived? How will that be regulated? How will they be audited to ensure whatever they're providing from an issuance standpoint is guaranteed and backed? There's a wide variety of open questions that need to be discussed. And we can always refer back to the whole DM or Libra fiasco. But that particular project was doomed from the start, to be honest. Obviously, there was a lot of sort of apprehension from central banking institutions about the role Libra would play in terms of issuing their own currency. There wasn't much dialogue between that big tech company with financial institutions. And so there is that lens that we need to consider. The other option is whether a big tech company partners with the central bank and offers to use their infrastructure to leverage a channel for CBDC. So we've seen recently AWS and Amazon on a discussion paper with Oliver Wyman talk about how they would go about issuing a CBDC. And essentially what they were saying was that we feel that we have a DLT-based solution. They're open to, a dialogue and discussion with central banks. And that would be another lens on how we can look at this discussion. And so those are the things I would want, the audience members to consider when we talk about big tech, the role of technology providers coming up with their own solutions. We need to make that distinguishment clear. Are we looking at big tech companies coming up with their own stable coins? Or are we looking at big tech players coming up with a particular solution impinged on their own infrastructure that can be leveraged by central banks? There's multiple conversations there. Over to you, Mr. Rachid.
Okay, thank you. So the second question perhaps is addressed to Dr. Hazik regarding the difference in application of CBDC between Islamic banks and conventional banks. Will be there any differences in terms of use or impact?
I think it depends on how you design it, as Ms. Azlina has repeatedly focused on the point in both of parts of the session. It depends on how you design it. So if an Islamic central bank wants to be more, in line with the understanding of what they think the Sharia wants them to achieve in terms of financial stability, financial inclusiveness, in protecting your sovereignty and hence your citizens' rights. You can design it a little bit different from a CBDC that would probably be designed for a conventional country. So it ultimately depends on how you want to design it, right? So if we find a lot of flaws within the fractionalized reserve system that we see in the conventional system, we can have a full reserve system for the Islamic countries, and we implement it through, by creating money or digital money that is fully backed by wealth that we have or commodities that we own. Okay, I hope that answers that question.
Yeah, thank you. The next question is actually the relationship between CBDCs and the normal cryptocurrencies that we know, like Bitcoin. So the question says, to what extent can the adoption of CBDCs impact the use of cryptocurrencies as a mode of payment? So, Ms. Ainur or Mrs. Lina, if you want to ask answer this question, please.
Can just take up also this question. I can just highlight all of that was mentioned by other colleagues, by speakers. We see this kind of trend here that consumers' demand for payments have changed now. They all need something which is very fast, instant, without intermediaries, and therefore we are noticing this kind of huge demand for cryptocurrencies. But whenever we analyze nature from economic perspective, we understand that they're not stable. They do not serve this kind of money functions as stable store of value, and they're not some of them are backed up, but in contrast to fiat money, which are backed up by the people's belief towards the government assets and the central banks assets. Here, when we will develop something alternative, which is a more stable but have all the same features like cryptocurrencies, because they could be built on this kind of DLT system and integrates all of these novelties and without intermediaries, all of this smart contracts, all of this business logics could be built up into these tokens, and if all of this demand from consumer demands will be satisfied immediately, to have alternative, they will be similar in terms of technology opportunities, but CBDC will be more stable, more backed up, and in addition to that, if government and central bank will satisfy their anonymity features, if the CBDC will be more anonymous, I suppose that it will highly will be more competitive environment for cryptocurrencies. But in terms of the economic and financial stability perspective, it will be more best things for people and from the regulatory perspective. I suppose it could really decrease the demand for cryptocurrencies if CBDC will be designed in a properly manner.
If I may, Mr. Rachid, I'd like to add an additional
Yes,
point
please.
to Ms. Aino's comment, which are all valid and I'm completely in agreement with. The only thing I would add is that if you were to speak to the average person who has invested into cryptocurrency, and if you were to analyze their mindset and motivation on why they invest in cryptocurrencies, more often than not, you'd find that some people are anti-establishment, right? Some people don't want, maybe some people has lost faith in the current monetary system. Some people who have invested in crypto would argue, well, look how the dollar has devalued over the last couple of years, you know? Whereas if I hold crypto, even though it's volatile, there is the odd chance that it could go up 100% overnight, right? So the mindset and the mentality of those who have invested in crypto, you know, that is an important consideration when we try to answer this question. So in my opinion, not the opinion of PwC, is that I think as CBDCs foster and grow and go live over the foreseeable future, I don't see much of an impact to cryptocurrency demand, because I think there's a strong base out there who have a mindset, right? Who have an agenda where they've lost faith in the monetary system, even though there are a number of issues with CBDC because of the volatility, because it's not technically backed by anything. But in order for cryptocurrencies to be impacted by CBDCs, there has to be a change in that mindset. And so, you know, that's kind of my consideration to this particular discussion. Yeah.
Thank
So
you,
we can just
Mrs.
add,
Lina, yes.
yeah, one more, maybe a couple of points. The first point is that, let's go back to the basics. Cryptocurrency is not currency. It's not legal tender. So it is a speculative asset. It is, you know, something that you can buy on speculation. Although there are countries that have accepted it as legal tender, even in the US, there are credit cards issued based on cryptos. El Salvador is one of the countries that accepted, you know, cryptos as legal tender. But in essence, it's not really currency. So that is one point that we need to get quite clear. The second point is that when it comes to comparing CBDCs with cryptocurrencies, is that central banks will not really issue cryptocurrency in what we see today, right? So from a central bank point of view, for it to be given legal tender, you know, for it to be a store value of money, for it to have that capability to act and function as cash, it cannot have the same mechanics as you know, the cryptos. So it's not really comparing apples with apples. I mean, you know, which is why I didn't really quite touch upon the Libra scandal or issue when Facebook wanted to do it early on, because it's not really comparable to CBDCs. It is an attempt, no doubt. It is something that you know, people want to move towards, but not quite. So to me, I suppose that mindset needs to be very clear to those who are, you know, following this webinar. Thank you.
Thank you so much. So I think we reached the end of this webinar. Ladies and gentlemen, we would like to thank all the speakers that joined us today for their valuable insights that they shared and the fruitful discussions that covered various aspects of this topic, starting with the overview, the technicalities, and all the things related to CBDC developments. We would like also to thank the audience and the participants for their attention and for the active participation. Please visit CIBAFI website and follow us on social media to be updated on CIBAFI's activities and initiatives. We thank you again, and we look forward to seeing you in our future events. Thank you, and have a very good day ahead. Assalamu alaikum wa rahmatullahi wa barakatuh.